friends, welcome to Notebook. In this chapter, we'll discuss about financial management. Let us take a quick trip down memory lane to Class 11. One of the characteristics of business is that it is an organized economic activity, which means it involves money. Money is required to start and run a business, and at the end of the day, if a business does not make money, it will not be sustainable. Finance or money is the lifeblood of any business. Money required for carrying out business activities is called business finance. Let us learn the concept of financial management and financial decision making via an example. Three friends, Rajesh, Prakash, and Sudha, opens a grocery shop in their locality. To start their business, they would need to take a place on rent, buy furniture, electrical fittings, weighing scale, etc. They would need to buy the groceries, vegetables, etc., which they would be selling in the shop. They would need to hire people, pay their salaries, pay taxes, electric bills, etc. They find out a place on the ground floor is available for rent of Rs 35,000 per month. They need to stock up the groceries in shop, which would cost them Rs 2,50,000. They would also need about Rs 15,000 per month to hire 3 people who will work for them in the shop. They would need to pay Rs 2 lakhs for the furniture, fridge, and other equipments. This comes to Rs 5 lakhs. All the 3 friends have Rs 1 lakh each, which they have saved and can be put in the business. Now they are short of Rs 2 lakhs. They go to the bank, which agree to give them a loan for Rs 2 lakhs at an interest rate of 10% per annum. So students, in the example you will see 2 financial objectives which have been achieved. Rajesh, Prakash and Sudha have figured out where will the money come from. Procurement of funds. This is also known as financing decisions. They also have found out what will they use the money for. Usage of funds, which is also known as investment decisions. The third objective, which is not mentioned in the example, but is a very important component, is the distribution of profits. When and how much is to be distributed amongst the owners, which we will discuss as the dividend decisions of a business. Be careful here. It is not about the distribution of profits. It is the giving back of money to the owners or shareholders. So financial management is about optimizing the procurement and usage of funds. It aims at reducing the cost of funds. Example of cost of fund is the interest to be paid to the bank. Reducing the risk the fund procured. Example, borrowed funds have a fixed commitment and timeline of payment, whether the business earns money or not. So there is a risk. Utilizing the fund in the right places. Buying furniture, procuring material, ensuring money is available when required. Regular flow of business. Avoid keeping unutilized or idle money. The role of the financial management is to rightly balance all the components to maximize returns on the money invested in the business. The amount of investment in fixed assets, current assets, how much to borrow from where, all these decisions have an impact on the profit and loss of the business. In our example, the decision of investing Rs 2 lakh for furniture, fridge and other equipments is to decide on the composition of fixed assets. The decision to investing Rs 3 lakhs in the running of the business, which is Rs 2,50,000 for the groceries, Rs 15,000 as salaries and rupees 35,000 as rent is the amount of current asset they would need to run the business. The decision for the three friends to put in rupees 1 lakh each and borrow rupees 2 lakhs from the bank all has an impact on the profit and loss of the business. Payment of interest reduces the profitability of the business. The main objective of the financial management is to maximize return for investors. In our case, it is Rajesh, Prakash and Sudha. And this is also known as wealth maximization concept. The concept of wealth maximization means how can the investor get the highest return. It could be by way of giving the money back to the investor or by increasing the value of the share price of the company. Example, the decision to not give money back to the investors but investing in new equipment or opening a new shop would increase the share prices of the business, as it shows the growth of the business. If the cost of borrowing from market is high and the decision of borrowing from a source where the cost could be lower is also a component of financial management. All these factors need to be considered while deciding on how to effectively use money. Hence, the importance of financial management. Students, with this we hope you have been able to get the concepts of financial management. In the next video, we'll elaborate a bit more on the financial decision process. See you soon.